Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com.
So welcome everyone to MacroHive Conversations. I'm Viresh, a strategist here at MacroHive. This week I'm here with Jonny Matthews of SuperMacro. Welcome, Jonny. How are you doing?
Yeah, fine, thanks. Thank you very much for having me on the show.
Yeah, no problem. Good to have you on. So let's dive in, as we always like to do, with your origin story. What did you study in university, and was it always inevitable you'd end up in finance and doing what you're doing now?
Far from it, actually. I studied engineering at Imperial College, which actually is a good way into finance. But, I didn't go to a very good school when I was growing up. And I just didn't think the finance industry wanted someone with my kind of accent and my kind of upbringing. And I actually went to work for British Aerospace, where they made aeroplanes after I graduated. It wasn't really what I wanted to do. And I did want to get into finance. I was very, very interested in finance. I did a master's degree in finance, and then I got my first job at Salomon Brothers. So that was my route into finance. I didn't really know what I wanted to do when I was at university, but eventually I found my calling, I guess.
Yeah, excellent. It's always one of those things that you end up doing, or you end up into finance somehow, and it's always a bit random. So you've also had an illustrious career working at Brevan Howard and some other great firms. Can you tell us about some of the lessons you've picked up along the way from your career?
Yeah. I mean, things, I joined Salomon Brothers in 1993. And of course, I'd read Liar's Poker a couple of times, 2 or 3 times. And I just wanted to be that obnoxious trader that's portrayed in Liar's Poker. And that's how I was. But you could get away with it. I mean, you really could back in those days. I was very aggressive. I was very determined. And I really wanted to do the best I could to make money for the firm. And I had a pretty successful career there. Salomon's was acquired by Citigroup. I became an MD and in charge of a department of derivatives traders. We were very pioneering. I did one of the first, if not the first, variance swap on an index. This is a complex volatility product. And at the time, the bid offer spreads, the margins that we made were huge because we didn't have competition. So we could make, fantastic money by offering this product to customers who typically wanted to sell. We kind of knew which way the flow was going to go. And we could completely hedge ourselves out and take very little risk. And what I found while I was working, as effectively a market maker, I was a trader, trading options and other more complex derivatives. I could sit with a portfolio of options which would decay over time, which was costing me money every day. But because I had the customer business, the flow business that was generating a P&L, overall, even on a bad month, I'd be up on the months. And if something happened in the world, some big event, then the market would move a long way and my options would pay off handsomely and I would look like a genius trader. And I think this was a bit of a problem for me. I thought I was this genius prop trader making all the money for Citigroup. And when I left after 11 years there, and I joined Brevan Howard as a portfolio manager, that was quite a steep learning curve because you go into a hedge fund and whatever trade you do, as soon as you do a trade, you're offside. Assuming you've paid an offer or you sold something on the bid, you're basically offside. So you really need to be pretty sure about what you're doing. You have no safety net from customer flow business. It's just purely you purely survive on your own trading ability and the research and so on. And in the early days of Brevan Howard, I did a lot of relative value trades. kind of thing where I would look at implied volatility on Nikkei versus the S&P 500 or correlation trades, complex derivative trades. But I joined there in 2004, and as time went on, I started to make, small amounts of money. But as we came into 2007, it became really clear the world was going to blow up. It really did. It was really very, very clear. I thought it was going to happen in 2007, and there was a nasty market wobble in the summer of 2007, and then everything recovered incredibly. And I just loaded the boat with downside options, with variance swaps, with these volatility products that would pay off handsomely if things got really nasty. All these kind of products that were priced way below where they should have been. I mean, in those days, the cost of protection, downside protection, was far too cheap. It really was. I mean, whether it was in CDSs, credit protection or equity protection or FX volatility, all these kind of things were far too cheap. And of course, 2008 came, and it was a great year for me. And then I really began to focus much more on macro trading. That just became my focus. And I'm not an economist. By training, I'm just a trader, and I try to learn everything that I can about economics to understand what is going on in the market. So after 2008, if you correctly came to the conclusion that the world was going to survive, which is what I thought, in 2009, the prices of just about every single asset was so smashed to pieces. You could buy anything. I mean, whether it was dividend swaps on equity indices, forwards on the Nikkei, which were, the forwards on the Nikkei were priced as if the dividends were going to be negative over the next few years. Credit, you could sell credit protection at ridiculous prices on in CDS form. There were all kinds of trades you could do, or you could just outright buy the equity market. So 2009 was another good year, and I stayed at Brevan Howard for 11 years, and then since then, after that, I started managing my own capital and writing the daily newsletter, my SuperMacro. And what I found is that by writing the research and the depth of understanding that you need to be able to articulate yourself on paper or verbally, the understanding that you need of the market and the economy, really does sharpen your trading. Now, I heard people talking about the need to write about trading and your thoughts and so on in the past, but I'd never believed it was true. But now I've been doing it for 4.5 years, and now I do actually manage a macro portfolio on behalf of Fortem Capital, as well as writing this note. I'm not going to give up writing the note. It is really, really valuable to me in helping my trading decisions. Great deal. So that's 30 years in a nutshell, though, for you. That's how I got to be where I am now.
Yeah, as a researcher, I can definitely say, having a process where you're writing all the time adds to the rigor of what you're doing. So I just wanted to get back to a couple of interesting points you brought up. So you mentioned in 2007, you sort of were expecting the system to blow up at that point. So I guess the first part is, what was that period like? Because it's always easy for those who weren't in the market to say it was inevitable. But clearly you were there at the time, you saw what was happening, and you were sort of waiting for it to happen. So what was that period like from, say, 2006 to 2008? And then the second part is, can you speak to a bit about how the markets have changed from, say, when you first started your career to what you see now in terms of, structure and things like this?
Yeah, well, in fact, in 2006, 2007, everything I read about the US housing market suggested It was an accident waiting to happen. People were massively over leveraging themselves to buy houses. There were mortgages. You could easily get a mortgage with no down payment. People were buying multiple homes and hoping to flip them. There were anecdotes of, waiters in San Diego earning $20,000 a year buying $400,000 condos, several of them. And it seemed obvious this really was an accident waiting to happen, on top of leveraging themselves up to buy the house. As the house price went up, they re-leveraged themselves by taking more money out, getting a bigger mortgage and spending the extra money on either another property, or an ATV, or a speedboat, or whatever it was, or cars. So it was very much if you like, an unsustainable credit-driven expansion, and both the household sector and the corporate sector were badly over-leveraged. It wasn't clear when the tipping point would be. And so it was very difficult to just, run a long volatility position in the expectation that things were about to blow up. What actually happened in the summer of 2007 was there was a kind of funding squeeze. The TED spread, the spread between Eurodollars and Treasury bills, blew out. There was some kind of funding squeeze. The repo rates really exploded. I was away at the time. I was visiting the US, and I didn't have any exposure to any options that I would like to have, would have liked to have had, while the market was selling off. I mean, the S&P sold off quite aggressively, and honestly, I felt sick as a dog. I thought, here I am, supposed to be this volatility expert, and I've missed opportunity of a lifetime. Well, as it happens, that wasn't that the market recovered. I think the Fed cut one of their benchmark rates at the time. The market stabilized. The S&P rallied. The stress in credit calmed down, and the market carried on rallying into the end of the year. And I just thought, I cannot miss this opportunity for the coming year. And at the time, variance swaps are complex products. I'm not sure what the quotes are like now, but at the time, I remember on the Euro stocks, the quote was 80. One of the French banks was quoting 18 to 18.1 in terms of implied volatility, which is crazy tight. That is zero margin. It was low with no margin, really. And I just loaded the boat with Euro stocks variance swaps, spreads on the DAX, all these kind of products that will pay off if the world blew up. And as it happens, when we rolled around into 2008, things did start to become unhinged very quickly. But market sold off into April. I remember this very, very clearly. The S&P sold off into April and then began rallying again, and things started calming down. And the implied volatility was moving up to 30 and then coming back down again, and back up to 30 and back down again. By the summer, I'd sort of decided, okay, I've got to get out, get out of everything, because I've made good money. I'm going to take the money and run. And I probably exited most of the positions prior to the big blow up when Lehman's collapsed. So I missed out on making as much as I could have done. I still made a bit more. I mean, the moves in implied volatility at the time were just insane, so crazy that even with a very, very small position, it made big chunks of money. I had a small residual position, and so that was 2000. That was 2008. What's changed now is that, first of all, there's no one now that experience kind of trained the market to price this tail risk very differently. There are no cheap, I haven't found any cheap, what we call, kind of tail risk hedges. There's nothing like that, nothing like there used to be back then. So, first of all, you can't put together something. I mean, you could do this in credit as well. You could buy the protection on the AAA tranche, which they were virtually giving away for free because this could never get impaired. And you could offset the carry with something, with a more risky tranche. You could, and that trade worked out. The same in implied volatility. You could buy these really out the money options for very, very little cost, and do some other trades to sort of offset the negative carry. You don't have that anymore. Those kind of opportunities are gone. And so I think it's much more difficult, and you've got to try to. I don't think you can successfully try to anticipate, a really, really adverse outcome and position yourself for that. What you've got to do is position yourself more around, I would say, less extreme events happening. Try to analyze the macro data, get a good idea of where rates are going and so on, and position yourself accordingly.
Yeah, that's great. And speaking of potentially less extreme events, let's talk about what's happening today. So yeah, from what I understand, you've been a sort of in the higher for longer camp in the US. Is that still your take, and how would you describe your general views on the US right now, especially as it pertains to what's been happening with tariff risks and things like this?
Yeah, well, first of all, the US economy, it ended the year in great shape. It really did, with very, very strong momentum. And you've got to bear in mind, household income is still growing at a very healthy pace. There are still more available jobs than there are unemployed workers. And both corporate and household balance sheets are incredibly healthy. By that, I mean the debt servicing costs for corporates as a percentage of their profit are the lowest in decades. And for the household sector as well, the overall debt servicing costs, that's principal payments and interest payments, are also as low as they've been for a couple of decades. Because basically, both the corporate sector deleveraged and termed out its debt, and the household sector in the US, it's relatively little cost. They could keep remortgaging at lower and lower rates. And so the average rates on all the outstanding mortgages in the US is currently 4%. I mean, if you want to get a new mortgage, you're going to have to pay 7%. So households are staying put with their existing mortgages. They're not increasing them and leveraging up in any way. They're not moving home either. But right now, the amount of equity there is in housing is enormous. But on top of that, households have an enormous amount of actual, stock market wealth. Household total wealth. The most recent figures we've got for Q3 was at an all-time record, north of 160 trillion, and it's only gone higher since then. So, we've got a healthy labour market, very strong corporate and household sector, and GDP growth, which has been extremely robust. I know Q4 GDP growth was a little lower than expected, but consumption growth was extremely strong. An inventory drawdown shaved about a percentage point from the headline GDP number. So I think as far as the tariffs are concerned, you've got to bear in mind, President Trump has inherited an incredibly strong, healthy economy. And if it ain't broke, don't fix it, basically. But for Trump, I think he's got this agenda, to tighten border control, to curtail fentanyl smuggling and illegal immigrants and so on. So he's threatened these 25% tariffs. Now, for the threat to be credible, he's got to show that he actually intends putting them in place, which is what he did, and then he's postponed the implication of those tariffs for a month on Canada and Mexico. The tariffs would be extremely damaging for certain sectors, certainly for the industrial sector, especially for the transportation, the auto sector. There'd be, I'm not going to say catastrophic, but really, really, there are severe implications. I mean, I just read this report from the Cato Institute a few days ago talking about how, certain large components of a car, like a transmission system or an engine, crisscross the border, whether it's the US-Canadian border or the US-Mexican border, 7 or 8 times before they become, part of a car. I don't know if the 25% tariff would apply to each time that part crosses the border, or if it's a one-time thing. But either way, I mean, it would be disastrous for the auto sector. But now, the Mexico and Canada have got a stay of execution, and hopefully, they pledge to tighten up border controls and do what they can to stop fentanyl flooding into the US. So I think it's kind of hopeful that they'll get by without the tariffs being imposed. For China, a 10% increase in the existing tariffs that are in place. Obviously, as far as China is concerned, that's not ideal. But the currency has dropped about, I don't know, something like 3% since Trump was elected. So that will absorb some of the hit. Obviously, the Chinese exporters will eat some of their, some of the hit as well. And President Xi of China and President Trump do have the opportunity to speak over the next few days, and hopefully they'll find some kind of agreement where perhaps Trump will dial back these tariffs. But I think as far as if the tariffs do go ahead, whether they're imposed for part of the year or whole of the year, either way, it'll have an impact on GDP growth. It'll lower GDP growth, and it'll raise prices. And I think even if the tariffs, as they are, just the 10% on China, and for now, nothing on Mexico and Canada, I think that will also have an upward pressure on goods pricing, because I think companies have to reconfigure their supply chains. They've got to take account of the risk of these tariffs being imposed. And net, we've had a period of declining goods prices over the past year or so. They've now flattened out. I think we may well see goods price inflation at a low level, but we may see it returning. And I think as far as the Fed is concerned, in theory, the Fed should be able to look through a one-off price level adjustment. Let's just say there's a 10% increase in tariffs on China, the prices go up by 10%. It's a one-off thing. The Fed can say, okay, it happened this year, it's not going to keep on happening. In theory, they could say, okay, it's a price level adjustment. But in practice, they've been caught out before by saying, calling it transitory. And I don't think they want to make that mistake again. So I think as far as the Fed's concerned, they may well be on hold for a bit longer than they would otherwise have been.
Right.
So,
yeah, so I was going to say, so thinking about tariffs again, so these specific tariffs, as Trump has mentioned and others in his team have mentioned, have been about this immigration issue and fentanyl and the like. How are you thinking about his broader tariff strategy? So, perhaps on the EU and perhaps, other countries, maybe even Japan in the future. Is this purely a revenue play? Is it a negotiating play? How should investors be thinking about his broader strategy or broader goals as it pertains to tariffs?
I'm not sure if it is a negotiating strategy or he genuinely believes that he can encourage manufacturing to come back to the US, and whether he thinks he's really going to raise a great deal of revenue from this. In theory, I've seen estimates that if he went ahead with the 25% tariffs on Mexico and Canada and 10% on China, could potentially raise 300 billion of revenue, which would make a small dent in the deficit. It would make a difference. And that might offset some of the tax cuts that he has in mind. Certainly, he's going to extend the TCJA, the previous tax cuts, but I believe there's additional tax cuts he's thinking of for companies that invest in certain industries. So I don't really know what his aim is here, whether it's a negotiating tactic to get them to tighten up border security and stop fentanyl production, or genuinely thinks you can reshore manufacturing. But I think in reality, he's got some sensible economists working in his team, and anyone with even the most basic knowledge of economics knows that there are benefits to both parties through trade. There is no point the US trying to I mean, I don't even know how the US would find the low-cost labor that it would need to replace some of the manufacturing that gets done in Mexico, for example. It just wouldn't happen. And you're better off to let a country like Mexico, where the cost of labor is very, very low, do some of the labor-intensive manufacturing jobs, and do the more highly skilled, perhaps more sophisticated manufacturing processes in the US, and then both parties will benefit.
So correct me if I'm wrong, but it seems like you're saying, growth perhaps slightly lower in 2025, inflation higher, Fed's on hold. What does that mean for your rates view and then the dollar as well going forward?
My rates view is it's when I first had my rates view back in 2022 which was that long-term yields were going a lot higher. It was very, very easy. We're starting from such a low base. When I first started selling treasuries, the 10-year yield was 1.2%, and I had a very, very big position. Now we're at 4.5%, 4.6%. I do think it can go to 5%. For a number of reasons. First of all the progress that's been made on inflation over the last couple of years, you've got to bear in mind that core inflation, I think it dipped down from 3.3 to 3.2 at the last reading. Core inflation has been above 3% for 3.5 years. And when you look at the components of inflation, you've got this really, really sticky services inflation, which really, hopefully we'll be able to show the chart, but the red bars, I think they are in the services inflation, hasn't really declined much at all. And if you just focus on that part of inflation compared to where it was prior to the pandemic, it's elevated and very, very slow moving. The other components, take energy and goods, those have been a drag on headline inflation, but that drag is now fading very rapidly. Food inflation is a small part of the total, but that also is fairly stable now. So the bottom line is, I think we're in a much higher inflationary world now. We're not going back to an environment that we were in between the financial crisis and the pandemic, where the Fed struggled to get inflation higher, and rates were really low. Long-term bond yields were extremely low, and and inflation was in a kind of 1% to 2% range. I think we're now in an environment where inflation is 3 to 4% maybe. The neutral rate is higher, and I think one of the factors that is keeping bond yields from moving higher at the moment is just anchoring. It's just expectations. Just people are so used to that environment of low rates. There are very few traders that have lived through that period, much higher rates. And so the expectation is that the Fed will keep cutting. And, if you're a treasury investor, this is your last chance to lock in a rate of 4.5% because the Fed's going to bring, the Fed funds rate down to 3%, and it's best to term out your investments. I think that is what's preventing bond yields from moving higher. I think that is wrong. I think the Fed is going to be on hold for the first half of this year. And that's really what's priced into the market. And I think progress after that is going to be very, very slow. There is a chance, there is a risk they don't make even cut at all this year. In which case, you will see the long end of the Treasury curve move a lot higher.
Yeah, perfect. And in terms of, the Fed's view of all this is, they might be worried about tariff risks this year, but, it could be a one-off. With services inflation, they've sort of been looking past rents, and they think market rents are coming down. Are they too complacent on rents and services in general?
I think it's right that rental inflation is coming down, but very, very slowly. The CPI measure of shelter inflation, which is mainly rents and owners equivalent rents, never really reflected the steep increases in rents that the US experienced during and after the pandemic. So there was a kind of catching up. Now, when you look at more real-time measures of rents like Zillow, new rent indices, or apartment list and these kind of things, rental inflation has slowed, but it's kind of stabilizing at about 3% or so, something like that, 3.5%. The CPI measure of rent inflation, I think, is about 5%. I think the two things will kind of converge towards 3.5% to 4%. I'm not sure they will go. I don't see how rental inflation is going to go that much lower. House prices are still climbing. They're at record highs. It's a slow-moving index. The CoreLogic S&P index now, it's a very slow-moving index. It's based on average prices over 3 months, and we get it with quite a delay. But on the basis of that, house prices are going up, purchase prices are going up, and so I think that's going to support rental yields. If you can't afford a house, you got to rent if you want somewhere to live. So I don't see rental inflation slowing that much while prices are doing what they're doing.
Right, and the last part of the Fed's sort of disinflation view in general has been the labour market. So even recently, Powell said, we don't really see the labour market adding to inflationary pressures. Is that also something you disagree with, or how are you thinking about the labour market in general right now, especially after the scare that we had sort of last year?
Well, it has cooled. Without a doubt, the labour market has cooled, and just earlier today we saw the latest job openings numbers, which were weaker than expected. And if you look at the quits rate from the jobs report, it's at 2% for a second consecutive month. That kind of suggests that people aren't rushing to quit their jobs. People typically, that quits rate is a good indicator of wage pressure, because people typically quit a job to get a better paid job. That's the reason most people, tell their bosses to shove it, really, is to get a better paid job. And it is that tends to drive wage inflation. So the quits rate is kind of lower than it was. The labour market is less dynamic. Wage growth, certainly average hourly earnings growth, has been running at 4%. That, I think, that may well slow a bit. But I don't expect, I really don't expect the labour market to suddenly fall off a cliff. If you look at corporate earnings, I mean, we're almost halfway through Q4 corporate earnings. Corporate earnings, certainly of the S&P 500, are on track to grow at somewhere between 12 and 13%. If the corporate sector is increasing its profit at that kind of rate, they have no reason to shed labour, certainly, and certainly seeing a very, very low level of layoffs. But by the same token, if their earnings are growing at that kind of pace, typically you'll find labour, good demand for labour. And that, I think, is, from my point of view, I just don't see why the labour market should slow down that much. It's actually accelerated the the last 3 or 4 payroll prints. We had a soft patch in the summer where average payroll growth was something like 120,000 a month for 3 months. And then for the last 3 or 4 months, it's been something like 170,000 a month. And Powell acknowledged that. And it's not the first time we've had a soft patch. I think we had one in the summer the previous year. So it's all the indications, as far as I'm concerned, are that the labour market is in reasonable balance now, as Powell says. Unemployment is low, 4.1%. A lot of what drove the unemployment rate higher towards the tail end of last year was a lot of immigration. There was something like a million people entered the US, most legally, of course, and some illegal immigrants, but both will affect the unemployment rate. And so the increase in the unemployment rate was driven more by an increase in the size of the labour force rather than fewer jobs out there. So, especially now that, immigration policy is a lot tighter, and this is even before, start deporting illegal immigrants. The labour market is set to become quite a bit tighter. I don't know whether that's enough to drive wage growth higher on its own. I just think it's in pretty good balance now.
Yeah, it makes sense. So potentially 5% on the 10-year, Fed staying on hold. Is a stronger dollar inevitable from here on that basis?
I think let's start with the euro. I mean, I think you're going to have to pick your currency now. It's not going to be straightforward. Previously, the dollar's just been rising against the euro, sterling, the yen, just Chinese yuan, it's just everything. And of course, the EM currencies. Now, I think you're going to have to be a bit more selective. European growth was weak, slightly weaker than expected, but beneath the surface were more encouraging signs. The preliminary GDP reports don't show the full breakdown, but funnily enough, it was certainly in Germany and Italy, and I think in France as well. It was exports that shaved quite a bit off the GDP number. Consumption growth was okay. So I think that Q4 GDP growth number is probably it exaggerates the weakness of the European economy, and I expect the European economy to be stronger in this quarter and to grow over the course of the year. Household income in Europe has been growing at a healthy pace. Household real income has been growing at a healthy pace. The negotiated wages, it's very delayed, but that was up at 5-point-something%. It's probably slower. Wage growth is probably much slower, but unemployment is close to a record low. You got strong levels of nominal wage growth, and of course, headline inflation has dropped a long way. So you got healthy real increases in income, this should drive stronger consumption in the Eurozone. And I do expect we'll see that over the coming quarters. So for Europe, I wouldn't be too bearish on the euro. Sterling, though, I think is really in a mess. I think the UK economy is going to really struggle. I think Chancellor Reeves' increase in the national insurance contribution, that's like a payroll tax, and the tax rate went up from 13.8% to 15%. It doesn't sound like a lot, 1.2 percentage points, but going from 13.8 to 15 is about an 8.5% increase. So company payroll taxes will go up 8.5%. On top of that, you got a hike in the minimum wage. Now these changes take place from April, but already we're seeing companies respond. We saw total employment. We've seen two consecutive months of declining total employment. This measure of total employment that I'm talking about is the measure that comes from HMRC records. It's the total number of payrolled employees, and they've declined to 30 or 40,000 in November and December. Vacancies have been declining for about 2.5 years now, but it's the first time we saw the actual total numbers of people employed start to decline. And I think companies are preparing for this increase in the payroll tax. Now, on top of that, on top of a sluggish labor market and much slower hiring and perhaps even some shedding of labor, on top of that, we're facing price hikes. Water bills are going to go up by something like, on average, 26% in April. Council tax bills will be going up. I think the energy price cap will be lifted as well for a third consecutive quarter. So there's a lot of price increases in the pipeline that are due to hit the economy in April. And the Bank of England, when it meets later this month, I think it's next week, is it next week or it might be this week, whenever it is, they will update their forecasts for the UK economy. I'm pretty sure they will lower their growth forecast. Their inflation forecast, though, is unlikely to be lowered simply because of these pipeline price pressures that are virtually set in stone. We know these prices are going to increase in April, and that will impact the consumer. So households are being hit they will be hit by less labor demand. I think pay growth will slow dramatically and prices will increase quite a bit. So you've got another cost of living crisis brewing right there. So I am quite bearish on the outlook for sterling.
Yeah,
when it comes.
Yeah, thank you. So in terms of equities, so tackling back to the US, we've had a great year for the last 2 years. What does 2025 look like? Should investors expect the same?
So don't expect the same. Back to back 25% increases for the S&P 500. We're not going to have that this year. If you look at earnings per share for the S&P 500, I think at the end of 2022, I think they were 220 something, and by the end of 2024, they got to 270 or something. I might have got those numbers wrong, but I know that earnings per share growth was something like 20% over those 2 years. The S&P index itself went up 50%. And that basically implies the PE ratio expanded a great deal, which it did. It went from below 17 to 22. So the rise in the S&P, the 50% increase in the S&P 500 over the last 2 years, was produced by something like a 20% increase in earnings per share and a 30% increase in the PE ratio. We're not going to have that again this year. We still are on track for healthy earnings growth. I mean, Q4 was great. There's no reason to expect earnings to fall off a cliff going forward either. But I think if anything, the multiple is too high for the S&P. Expectations are too high. I think we're going to have a very choppy year. It's going to be very difficult. For me, it's difficult to see the S&P making a great deal of progress from where it is right now. I think there's more downside risk than there is upside risk.
And obviously AI has been a significant theme of what's driven equity returns, and it's hard to talk about US stocks without talking about AI. And I know you have some interesting thoughts on that. So how should macro investors think about AI, and how are you thinking about the impact of AI on the economy going forward as well?
I think I can't remember the name of the economist, but at the time when the computer revolution was getting going, he said, we can see the productivity everywhere except in the data, or something like that, talking about the early days of the computer revolution. And I think that's probably going to be the same in AI. I'm pretty convinced that it will have a very positive impact on a lot of service sector businesses in law, finance, whatever. The ability to very, very powerfully do analysis on data with just a simple language commands will improve productivity immensely. But it will take time. I think all this excitement, it's suddenly getting, this DeepSeek software has been around for a few months, but all of a sudden, a couple of weekends ago, the market seemed to suddenly latch onto it. I think that is really a positive supply shock. I don't think it's necessarily negative for all these providers of or the users of AI. That's all. I think if anything, it means you've got access to lower cost AI that runs on cheaper computers and needs less power. Great. It should enhance the adoption of AI. So I'm positive on the outlook for the adoption of AI and its ability to improve productivity in the service sector. But it may take time. It just may take longer than people expect.
So moving to the rest of the world, I know you touched on the UK and Europe a bit, but just circling sort of further into Europe. One of the interesting things has been just how much Germany struggled, even as you said some other parts of Europe has been fine. Spain, for instance. Is Germany's growth model disrupted, and how does Europe as a whole function in 2025, especially with the risk of Trump while that's happening?
I think first of all, I think as far as the Eurozone is concerned, there is so much negative sentiment towards the region that is kind of baked into the prices. If you look at market prices of interest rates, forward starting OIS swaps, in other words, what the market's expectation of where the ECB will take the deposit rate over the next year, the market expects the deposit rate to fall below 2% well before the end of the year, which, if you think about it, if they have inflation on target at 2%, that's basically suggesting a negative real rate. That is below most economists' estimates of the neutral rate for the Eurozone. And I really don't think the ECB needs to be that stimulative. So market is pricing about something like 85 basis points of additional cutting before the end of the year. I don't think the ECB is going to get that far. I think growth will be something like about 1% over the year, which is not disastrous. It's not, it's not great, but it's not disastrous. Turning to the German economy, I think part of what's hit the German economy is obviously its reliance on cheap Russian energy, which, that's come to an end, and the disastrous decision by former Chancellor Merkel to get rid of the nukes. It seemed like the most misguided decision at the time. I think at the time she wanted to get the green vote. There was that disaster in Fukushima, so she just said, "Okay, well, we're going to ban all the nuclear reactors," and that way she could get hopefully get some of the votes from the people that supported the Green Party to keep herself in power. It was an idiotic decision because Germany are busy, burning coal to sustain their power needs these days. So, Germany's industrial sector has been hit by that. I think, but if you look at the PMIs from Europe, the German services sector has picked up quite a bit. The PMI is north of 50, and I'm hopeful that the manufacturing sector in Germany and the rest of the Eurozone is over the worst of it. If they get hit with tariffs, like China has, kind of 10% tariff, then I think it will be very, very bad for Germany. I just hope they can avoid. I hope the Europeans can come to some kind of agreement to buy a whole load of US liquefied natural gas, or whatever it is Trump wants. They could, or increase defense spending, whatever it is he wants. They'll agree to it. It's not such a big deal. Higher defense spending, more LNG imports. And that way avoid the tariffs. That's my hope there. And if that is the case, I think we'll see better data out of the Eurozone over the next few months.
Right. And what else? What other thoughts you have in terms of rest of the world? Is there anything else that catches your eye there?
Well, of course, Japan. You did mention Japan. It's interesting that the 10-year Japanese bond has made it's just reached the highest since 2011. They have inflation of about 3% currently. There's a lot of stuff that goes on in Japan with VAT hikes and reductions and subsidies and all the rest of it that kind of moves the inflation rate around a bit at the headline level. But I think the underlying rate of inflation has been sustained above the 2% target for I don't remember how long now, quite some time, certainly over a year. Wage growth has been very, very healthy. Obviously, unemployment is super low there, something like 2.5%. It is just possible that they have finally exited this period of deflationary risk. And so the BOJ, I think the BOJ is expected to hike once every 6 months or so. There's not much priced in for BOJ hikes. That could prove wrong. I think the BOJ could really normalize rates, and we could see JGB yields move quite a bit higher. In which case, the yen should strengthen. But I think we've got to get through the April pay negotiations, the Shunto, that round of pay negotiations, and then the BOJ will see, whether they manage to secure, another year of decent pay growth. So I'll have to see how that works out. Right now, at least, the country doesn't seem to be in the tariff crosshairs. Surprising, really. I mean, when you think of how many Japanese cars are sent over to the US compared to European cars and Chinese cars.
Yeah, and how are you thinking about China right now? We obviously had some news on stimulus last year. Should we expect more of a turnaround this year?
Well, I think the problem is the real estate market there is quite deeply challenged. They went pretty crazy. I saw a report a while ago that they were real estate activity as a percentage of GDP was on a par with Spain prior to the financial crisis. the whole economy was far too dependent on the real estate sector. And the problem is they've had this bust now, and they're in the process of this, I won't call it a full-blown balance sheet recession, but deleveraging and working out debt resolution and so on. And it takes a long time to recover from that. When the financial crisis first happened, there was a book published by these economists, Reinhardt and Rogoff, 8 Centuries of Financial Folly, which we all read, because they did this wonderful analysis of 8 centuries of experience of government debt getting too high, the private sector leverage getting excessive, and then the whole thing collapses. And the conclusion from that book was really, it typically takes about a decade to escape from that. And I remember reading it at the time and thinking, oh, God, no, I hope it doesn't take a whole decade, but it did. And they were pretty much spot on. It took a decade really for the US to escape. And the US was just, getting out of this mess when COVID hit. And I think China, faces the same challenges. Maybe it won't be, people like to draw analogies with Japan when the Japanese real estate market collapsed in Japan and, they went into deflation. Well, certainly there was risk of deflation. There were parallels with China, very strong parallels, and China's inflation rate is something like 0.1 or 0.2% at the moment. So there are strong parallels. Very few people believe the GDP growth figures that we got for last year, 5%, spot on the PBOC target. No one believes that. And I also think that, I think China is going to face a very challenging time. Of course, there is capacity for further stimulus. Government debt to GDP is relatively low, something like 40%. It's low compared to this country or the US. So there is the capacity, but I think a lot of the debt is at the local government level. So I'm it's wrong to just say, okay, they're going to follow the exact same path of Japan, but by the same token, I just don't think they're going to have an easy time of it.
Great. And moving on to sort of more market views now, what are some of your favorite trades that you're thinking about, or areas of the market which you think are mispriced?
I have, at the moment, I've got some downside options on sterling, obviously. I have a very negative view of the UK economy over the next few months. So that's probably one of my strongest opinions. I'm also, it's a question of timing. Implied volatility in the options market, in the US options market, is really still relatively low. So I think you've got to be nimble. I've on a few occasions this year, I bought relatively short-dated put spreads. Anything from 1 week to 1 month, when the option prices, when the implied volatility was low. So I didn't have to risk a lot of premium, and on both occasions paid off handsomely. This most recent, I went into this weekend with some put spreads, and I sold half the position. Obviously, the other half is slightly more than half. The balance is going to go out for a donut, but made very good money from the position that I did have. And I think that is the strategy that I'm going to adopt for the S&P 500 for this year. Anytime that I find the opportunity to buy some cheap downside protection, I'm going to take it. For the other markets, for Europe and the UK, these are what I would call, these markets consist of value stocks, and value has been doing a bit better versus growth stocks recently. And those markets have done very well. They've really, so far this year, really done quite well. I think the Euro Stoxx was up 10% for the year to date, and the FTSE about 8%, something like that. They are still very good value, but growth expectations are very low. So I think they represent a more stable home for your investment cash. I don't think you're not gonna see kind of 25% year on year price growth in those markets over the next couple of years, but I think it'll be a more stable and potentially better performing market than the US. I think the US has some challenges.
Yeah, sort of the US outperformance has gone on for a long time, hasn't it? So that was a great whirlwind tour around the globe. Before we end, we always like to do some personal questions. So the first one I'd like to start off with is, what's the best investment advice you've received during your career?
Well, actually, I think loads of brilliant investment advice. But my dad years ago, my dad was in the scrap metal trade and used to hedge on the London Metal Exchange because he'd have massive stock loads of physical copper and aluminium and would hedge on the LME. And one of his colleagues removed the hedge, thinking, the price can't go any lower. And one of the most important thing that I would say is never think it can't go any lower. Those are the most dangerous words you can hear when it comes to investing. It can't go any lower. The price of something has gone down and down and down. I mean, just think of crude when the pandemic struck. It was at zero. It can't go any lower. Well, it did. It went actually negative. I mean, so, and that's the same for everything. On the upside as well, to say, well, it can't go any higher. A lot of products that we trade, they are just commodities. The price can go anywhere. That includes high volatility. I was at Salomon Brothers during the LTCM crisis, and a lot of our we had a proprietary trading desk, and they were mainly doing fixed income prop trading. But they also replicated a lot of the trades that LTCM had on at the time, and they were short variance swaps on the DAX, on the FTSE, 5-year variance swaps, with the idea that realized volatility on these indices never got anywhere near to 30. And these variance swaps were trading at an implied volatility of 25, 26, 30, whatever. And the problem is, it didn't matter that realized volatility wasn't going to get that high. Implied volatility just went up and up and up and up and up. And the problem with the variance swap is, as the vol goes higher, your exposure gets bigger. There's this convex exposure. And so when the volatility got to, the high 30s and up to 40, the order came down from up above. You've got to cut, you've got to get out. And it was the same for LTCM, and it was the same across the whole city. Everybody got squeezed out of their positions, and it was extremely painful, extremely painful. So that's a very strong lesson. Never look at a price and say it can't go any lower or it can't go any higher. It can. Believe me, it can.
Yeah, it definitely can. So we also have, a number of students who like listening to this podcast. So what advice would you give to them, to those who are coming out of university for the rest of their career?
Well, first and foremost, you've got to do something that you enjoy. I mean, just because finance has in the past, certainly is now, quite a lucrative profession. It's not as good as it used to be if you just go and join an investment bank. It's tougher now. It's much harder to get into. It's more challenging career to pursue, and you've got to really enjoy it because you've got to be willing to put in the work. You've got to be willing to put in the hours, and you've got to be willing to be kicked in the teeth several times if you're a trader. It is very painful being a trader. And you've got to have the resilience to cope with that. But if it's something that you want to do, really, go for it and really give everything you've got. Make sure you get good grades, make sure you're near the top of your class, make sure you're the best possible candidate that you could be for the opportunities that are out there, because it's very, very competitive now.
Yeah, absolutely. And then moving on to sort of how you spend your time, have there been any books or films that have taken your interest lately that you'd like to share?
Books, there's loads of books that I've read that were influential. Market Wizards, I think there's 3 volumes of that. Liar's Poker, but that's interesting for the history of the mortgage market and for an insight into how traders behaved back in the day. Things are not like that now. Anyway, Reinhardt and Rogoff, the book that I mentioned, 8 Centuries of Financial Policy. I mean, there's so many books that I've read. What I would say is that whatever book you have, any of the really good trading books or investment books, you're typically going to go through the whole book and only find 2 or 3 good ideas. That's what you've got to expect. Those little gems are great. Fold the page, make some notes or whatever. You'll pick up 2 or 3 really valuable pieces of information that you should try to remember and keep them in the back of your head.
Fantastic. And how can people contact you or follow your work if they'd like to do that?
Oh, yeah. Well, the website is super-macro.com. You can just click on that. You can get a free 30-day subscription. Or you can follow me on Twitter. I think it's at super_macro. Search around for SuperMacro and hopefully you'll find me there on Twitter. But yeah, I mean, if you want to try the daily note, I produce this daily note, SuperMacro. Each day I discuss the previous day's data and the implications for markets, if there are any. And then on the weekend, it's a more in-depth analysis. It's a kind of broad summary of the week. It's a more in-depth look at the markets and where the opportunities are. And I also talk about the trades that I'm putting on or I have on.
Right. No, and I've seen some of your work and I can say, yeah, it's definitely really good. So yeah, thanks again, Jonny. I'm sure everyone else has enjoyed this as much as I have. And thanks for your time.
Well, thank you for having me on the show. It's been a pleasure. Thank you.
Thanks, Jonny.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.